This may be the 20th or so TigerTalks that we've hosted now in the last 3 or 4 years. We do them here in the city, up in Boston, Chicago, LA, the Bay Area, other cities going forward, and hopefully over in Europe and maybe even the Far East this coming year. So, my name is Don Sykes. I, along with several colleagues, work at a body on campus called the Princeton Entrepreneurship Council. And more about that later. Really delighted to have a panel on the FinTech Frontier and to host it at a wonderful FinTech company. And TigerTalks don't actually come together without tremendously generous hosts who open up really cool spaces like IEX. So I would like to invite Ben Biglari to come up, who is with IEX, to give all of you a little bit of background as to the company. Ben.
Thank you. Hi everyone, thank you so much for being here. IEX welcomes you. We're very excited to host this interesting talk about AI, FinTech, and our data. My name is Ben Biglari. I work here at IEX on the quantitative research team, and I'm also a Princeton alumnus. I graduated from the PhD Con program in 2015. Before we get started, I won't be long, but I do want to take a minute to give a couple of thank yous. First thank you goes to Krista, who is our office manager. She's here. She put on a lot of work to organize this event, so please join me. Also want to thank Caitlin, who is our talent management lead. She's in the back here. She also worked a lot on these events. I want to thank Princeton Entrepreneurship Council staff, Don, Diane, and all of the panelists. We're really thankful, grateful for you to take the time to spend this time with us and share your perspective. So, thank you. All right, very quickly, a little bit of background on IEX. As you may know, IEX is the newest US stock exchange. We've been approved a little over 2 years ago. We're one of 13 equities exchanges in the US. Other exchanges include NYSE and NASDAQ, probably others that some of you have never heard of. IEX was built with the mission of creating fair markets, and the way we do that is by doing very conscious market design decisions. One of the things we're the most famous for maybe is our speed bump. This is an example. There are other examples. The type of data that we will sell about our members, the type of prices, fees that we charge, and many others. I'd be very happy to get into more details after the panel if you want to talk about that. In less than 2 years, IEX became one of the 10 largest exchange operators worldwide by national value traded. Just last week, we saw our record intraday market share at 3.5%, so we're really going through exciting times. And good news, we're hiring. We have a lot of open positions. We have positions open on the exchange side, also recently launched a number of other business lines. So I invite, a lot of these roles are quant heavy. Actually, we are hiring in my own team in quant research, but there are other roles with a quant profile. So I invite you to check our website, to talk to me or to talk to Kate, again, who's in the back there, if you want more information or if you're interested. So with that, again, welcome on behalf of IEX. Hope you have a good evening, and I'll turn it to Randall.
Thank you, Ben. Really delighted to be here. And again, thank you to the IEX Group for hosting this event. Speaking of hosts, we often at PEC partner with other campus colleagues to bring on, to sponsor and to present these events. And delighted that Wendell Collins from the Bendheim Center for Finance is here once again to help bring this particular event together. We worked together 18 months or so ago on a blockchain event that was attended by about 400 alumni. It's great to see a lot of people here tonight as well. So Wendell, welcome, and please share a few words.
Welcome. I do want to, because one of my jobs at Princeton is run speaker series. For those of you in the back, there are lots of seats up front, right on the front row, right here. and the sofa. So please come up if you're not seated. And if you haven't already, turn off your cell phone, silence your cell phone. So as Don said, I'm Rachel Collins, Director of Corporate Relations for the Bendheim Center for Finance, which is the home of our Master in Finance program, some of whom are our students and alumni are here tonight, as well as the undergraduate certificate in finance, and some of our alumni and students are here from that program as well. So why PEC partnerships? Well, FinTech and technology are changing the face of finance, and our students are increasingly moving into FinTech and technology roles. And so we believe it's important to partner with the entrepreneurial ecosystem on campus led by the Princeton Entrepreneurship Council and the Keller Center. Had the benefit of being out at PEC's conference in the Bay Area, where Master in Finance and undergraduate certificate in finance alumni and students participated. So I encourage finance students to get involved in PEC. For those of you who are finance alumni that are interested in FinTech and technology and the intersection of finance and technology, we welcome your involvement in several ways. We have an internship program for undergrads and Master in Finance students. We have a career speaker series, and we're always looking for great speakers, especially alumni. We support recruiting relationships through our corporate affiliates program. So if you're hiring, please let me know. We only window in the directory at Princeton, so you can easily find me. And then we love to do these kinds of events around the country. So we welcome any ideas for talks, speakers on campus or around the country. So thank you again for joining us, and I'll turn it back to Don.
All right, Michael, again, thank you for your partnership. By the way, the other thing that we try to do with TigerTalks is invite students to come from campus. We provide training in subway transportation. And can I just ask the students who are here just to stand up so that folks can see who you are, and hopefully you can network with them. Notice there in the front row. And before I introduce Margaret, I need to stand next to my Starbucks cup. Starbucks apparently made a call, Game of Thrones Sunday night, PEC Thursday night. So they're marvelous marketeers, aren't they? In any event, let's get on to the panel. Really fascinating panel discussion tonight, and it will be moderated by Margaret Holan. Margaret earned a PhD in math at Princeton a couple decades or so ago. I won't say precisely how many years ago, but far fewer years than when I graduated from Princeton, however. And then she had a marvelous career as a partner at Goldman Sachs, focusing on data and analytics, and did some marvelous, really leading, cutting-edge stuff at Goldman. Recently, Princeton was able to lure her back to campus, and she is a lecturer in the Orphy department and has developed a course on FinTech that involves data analytics and machine learning. And some of our students are here tonight, so I guess that's a requirement for the class. But in addition to living here in New York and raising a family, she also advises several companies and makes angel investments in many of those, including some really cool Princeton startups. ThinkNum is one. Maybe many of you have heard about ThinkNum. They're an alternative data company. There's university funding, and then there's Laura's company, Stratify, and Laura's on the panel tonight. So let me turn this over to Margaret, and we'll get on finally now to the panel.
All right, well, it's great to be here, and Ben and IEX, thank you so much for hosting us. It's been wonderful to be back on campus, and it's really gorgeous when it flowers in the spring, and we see these rituals like senior theses getting turned in. These first students gave their thesis presentations on Tuesday. They did awesome jobs, and it feels really timeless. And it's interesting to reflect on really what has changed in those just few years since I was there. And I would say there is, back in the day, right? Finance was a pretty staid career, and it's great to see students who see finance now really changing. It's really conspicuous what they see. There are new payment services and new ways to borrow, right? FinTech lenders that will approve you in minutes, but all sorts of new entrants and new ways to invest, robo-advisors. So it's really, they see things changing and they're curious and they want to make that change happen, and that certainly was great for me. Sort of an occasion to launch a course and get a lot of great energy into a classroom, which of course at Princeton meant that they ended up doing like pencil and paper math, looking at fundamentals of machine learning, and but the energy has propelled us through, and they've been able to see how what they're learning really is applied by companies. So Laura, who you'll hear from, came to speak to the class about generative modeling and how interesting that is as an approach to machine learning. Jean Tarkington, who's the founder of FundingU, which is an inclusive student lender, which is looking to use transcripts to offer loans to students who would otherwise have to drop out of college so that they can complete college. And that was inspired by the experience of Jean's roommate at Princeton. And hearing what she's doing and how she has to deploy the sort of machine learning and alternative data that we're studying is deeply inspiring. So as we've done all that, we tried to focus on a couple of questions, and I'll just share those to frame the discussion before we get on to hearing from our amazing panel, which is, really, we hear a lot about alternative data, and we hear a lot about AI and machine learning models, and how important are they relative to what's going on in FinTech versus the other parts of the technology infrastructure that deliver the service changes in services that we're seeing. And then I think it's just something to consider, and that we'll explore on the panel. And the question of how is FinTech delivering impact, and impact that works for customers and for companies and for investors, obviously something I'm very interested in, but that also from a systemic perspective can serve goals of inclusion and fairness and transparency, and ultimately incentive alignment that's important to having finance, and the economy continue to be robust. So we know it's a powerful tool, and it can deliver huge returns when we innovate and deliver services more efficiently. But I think we all do that with kind of a sense of responsibility for what the outcomes can be. So with that in mind, I'm excited to hear from an amazing group of Princetonians who are leading the charge in the field. And I don't know if everyone wants to come up, and I'll make Ben already ask. Ben has been introduced, so I'll start with just a couple of words on my fellow speakers, starting with, I think, Hamid Biglari. I'm sorry, I'm going to not pronounce your name perfectly.
Exactly right.
He's a Princeton PhD in Astrophysical Sciences who, in his own words, doesn't seem to be able to hold the job very long. So what jobs has he had? So he started as a theoretical plasma physicist at Princeton, then moved on to be a partner at McKinsey & Company. Then was a top banking executive at Citigroup, and currently he's a senior executive at Point72, a major hedge fund, and amidst all that has been a long-serving advisor of the Bendheim Center of Finance. So I have to just say, in my words, when I hear Hamid's bio, I just say, wow. It's obviously having led efforts across a diverse range of financial organizations, he's got a very unique vantage point to share with us. So glad
Thank you.
to have you here.
Thank you.
Oh, you have a mic. I'm sorry, I'm the only one. Okay, I will. Do you want to? I don't know, Hamid, if you want to say a few words before we.
I think you did it perfectly. I have nothing else to add.
All right, awesome. Okay, so Kathleen, after graduating Princeton with a degree in history, Kathleen pursued a career in asset and wealth management, and her trajectory took her from being an analyst out of college to being a portfolio manager, and then a senior global business leader crafting strategy. She currently leads NYU Stern's FinTech initiative as a professor and as a center director, and is on the board of two tech-first financial services company, the LSE, which is a parent of the London Stock Exchange, which is, I guess, FinTech from 1801, but also, is a number of other exchanges, indices like Russell, clearinghouses, and she's also on the board of a wealth management tech company, Evolut.
Thank you.
So, and Laura. Ben will be next, but I guess we got to hear from you earlier. So Laura graduated from Orphe in 2003. And went to work for JP Morgan, first as an investment banking analyst and then in sales and trading, where she launched and led a new business line focused on algorithmic trading strategies. But as she was deploying technology to help her teams, she was thinking, this is really cool. There's potential for technology and AI to be transforming these businesses much more broadly. And I want to start my own company to make that happen. And she went back to Columbia Business School, where she had met up with similarly minded people, a few of whom became her co-founders of her company, Stratified, where she is CEO, and they are an AI company with next generation models that not only give you better predictions, but also rich explanations and relatable insights. So we'll get to hear more about that as we talk. But Laura,
Amazing.
welcome.
Thank you. Thank you so much.
All right. So none too soon. We have a series of questions. It's a broad topic, but I'll focus on a question that each panelist will respond to, and then we'll have some questions that a few of them do, and then we'll have questions from the audience. So Ben. Okay. I'm sorry. Can everyone hear me? I guess I should. Ben, big data and AI are transforming sectors, from retail to transportation to healthcare. From a modeling perspective, though, what are the challenges that are unique to finance?
Yes, thank you. Thank you for all these introductions. So to set the stage, a lot of people are very interested and excited about the great successes of recent machine learning and AI techniques in things like visions, natural language processing, even playing games, and that's good reasons to be excited. And so many people are interested to bring those techniques to finance and finance applications. There are specific challenges, though, to applying those techniques in finance. I think like one well-understood example, maybe the first example, is that the thing that people would want to forecast the most is prices. Will price go up, price go down? And there are very good reasons, theoretical reasons why you cannot do that, right? So I think that's the first example that everybody should keep in mind. That being said, it's not the most interesting reason why machine learning has particular challenges in finance. I think for me the most interesting reason is that markets are about humans. Markets is a place where humans meet. They need to trade with each other, hopefully in a mutually beneficial way. But because it involves humans, humans are special. Humans are forward-looking. They have expectations about the future, and they're going to bring those expectations to the decision-making that they are doing. Humans are strategic. When it comes to the market, they spend a lot of time thinking about what other people in the markets are also going to do, and maybe they're going to try to take advantage of that. And these are challenges for many of the machine learning tools that are out there. Let me take two specific examples. The first example is you have to take into account how people react to incentives. An easy example is, say IEX currently received 10 million orders of a certain type, charges some fee, get $10,000 every day out of that. We double the fee. Are we going to make $20 million out of that? Probably not, right? People are going to reassess. Maybe there are cheaper ways to trade. They're going to trade less. And it's very hard to predict this and to forecast this. Maybe people would not get tripped up, in such a simple example, but this comes up in more complicated examples where it may be harder to see that the same mechanisms are at play. So, for example, recently we have at IEX an order type that floats at the national best bid. Very recently, and under some circumstances, it's able to step up. We recently decided to start floating it 1 cent below the national best bid. It's not in production yet, but it's been approved, so it's going to happen. And so now we may be interested to forecast or to know what the fill rates are going to look like, what's going to happen. To know what is the probability that this order will get filled, we can take the number of contrast side orders that come to the order. Currently, we can take So currently it's enough to come to national best bid, and tomorrow they will have to come to national best bid plus one. Can we take the current order flow that we receive and make this prediction? Will people adjust and start sending their orders like 1 cent deeper to match our new mechanisms? It's extremely hard to predict, but we have to try to make predictions before we make a decision. The last and second example where humans bring an interesting aspect to the question, I think, is time, the notion of time. When as you agree, people bring their expectations in the decision making that they are doing, and when you look at the data, decision makers with expectations is as if they were taking the future and bringing it to the past or to the present. So, for example, somebody buys, the price goes up. Did the price went up because she bought, or did she knew that the price was going to go up and then bought in anticipation of that? We spend a lot of time thinking about this question. We think about this question at the microsecond level. We think of this question at an hours or days level. And I'm not going to say that we always have a good answer for that, but I think the main takeaway for me is that we try to stay very humble and take into account all these aspects when we try to interpret and make predictions.
So I'm cracking up because one of the things I teach in my class is when Brad and the president of BATS went mano a mano on CNBC about the difference between finance time and clock time. So that's why you have a business.
Yes.
Thank you. So Laura, two downsides of AI that we hear a lot about are biased data and black box models that don't reveal what drives their output. On the other hand, it seems hard that we could go wrong with anything that gives us awesome predictions and can be supported by just the most fulsome data sets that you have available. So how much do bias and transparency impact how AI is getting deployed in finance?
Thank you so much. Definitely a very hot topic right now, that's for sure. We like to joke at our company that if blockchain and AI were the hottest things on the block 2 years ago, transparent machine learning is the hottest kid around right now, and something everybody is definitely after, because these problems of bias and not understanding what's going on in the algorithm are really huge and can lead to some pretty disastrous impacts and very costly impacts on the bottom line for many folks out there. You don't need to look farther than the recent news out of nice small technology companies like Facebook and Amazon and the huge hits that they've taken recently regarding not understanding exactly how their algorithms were working, and then as a result having biased results from those algorithms, even in the case where they're not actually making necessarily financial predictions, where the stakes are even higher, but they are still making important life-changing decisions for folks. So I like to think about this question first from the data element. Right? As you mentioned, Margaret, there's more data available out there than ever. The proliferation of data and alternative data and big data sets and our ability to actually work with them is greater than ever, and it's only growing with every moment. But the data sets are growing, and our ability to actually compute meaningful values from them is also growing with every single day at a very, very rapid pace. People talk about this a lot. That said, though, any model that you build based on data is going to only be as good as the data that you trained it on. I would argue that most data sets are fundamentally incomplete. At very least, one way that they're incomplete is that they're backward-looking. It's very hard to find a really accurate data set that has all the information about the future. If we had that, all of us wouldn't be in this room today. We'd be out, I don't know, on a beach somewhere doing great things. But it's very hard to actually find a complete data set for the problem that you are trying to predict. At very least, oftentimes data that you're training off of is biased based on past human decisions. Is one really good way that oftentimes data is biased. And even though many times algorithms were introduced to try to help cure these biases, these human biases that we all know have been out there for a long, long time, if the data reflects that same human decision-making, chances are the data will also be biased. That doesn't mean that there's nothing that can be done to solve these problems. It just means that one has to be extraordinarily thoughtful when using any sort of algorithmic approach recognizing that that algorithm is going to at best be as accurate as the data that you are training on. Unless you use one of these advanced methodologies that have come out lately, many of which are quite easy to use. Ours is, of course, that help you impart your own expertise, your own views about how the future will be different from the past, your own expertise about something that may be missing from your data or may be lacking in your data. So if you will, you can teach the algorithm additional things that it's not learning from the data. Just trusting that the data will have the answers in and of itself is not going to get you there. And I would say lastly on this point, I think it's important to just talk about the concept of accuracy. I'm sure all of us, appreciate the hunt for accuracy when building models, especially building predictive models. I like to say that accuracy is often a very subjective measure, and again, accurate at doing what, right? Again, accurate at predicting the data you already have that may not be a complete representation of the universe of potential outcomes. Is that really that valuable? Maybe in certain cases, in others, not so much. The data that was from the past, that by definition, especially in finance, is probably not going to be the same as the data in the future. Is accuracy at defining that past all you need to do? Absolutely not. So accuracy is one important metric, but only one that is really important to keep an eye on when actually building an appropriate strategy, especially in something like an industry in finance, not just because of regulation, but also to make the best and right decisions.
Thank you. So Hamid, moving from the toolkit to the applications, hedge funds like quotes have been used to, or the racing cars of the investment management industry. And I'm interested to hear, what promise do you think machine learning holds for hedge funds? What are the challenges that you see to capturing that promise? And what's the current state?
Sure. So that's a fairly broad question, and let me try to narrow it to what is often thought of as the holy grail of hedge funds investment management, which is the search for alpha. For those of you who don't know what alpha is, the holy grail of investment management is to look for returns in excess of a market for a certain asset class, and that excess return is called alpha. So, what is the promise of machine learning in this space? Basically, all the quantitative, very smart quantitative tools that practitioners deploy are premised on human intuition and mental frameworks of how models work. The promise is that by analyzing millions of pieces of data, these techniques will uncover new signals that have heretofore not been identified by human beings, and therefore provide new sources of alpha generation. So that's the promise. That's much easier said than done. And I'm going to pick up on a couple of things that both Ben and Laura said and give them a somewhat orthogonal perspective. So financial markets, or let's say price movements in financial markets, are based on changes in human behavior. And in that sense, financial markets make it very difficult to apply machine learning for three reasons. The first is that financial markets are self-referential, meaning that market participants change their behavior when they see models of market behavior, thus negating the whole explanatory power of that model. And those of you who have, you've seen elements of self-referential problems in the past. If you've studied mathematical logic, you've seen it in Gödel's incompleteness theorem. If you've studied computer science, you've seen it in Turing's halting problem. If you've studied physics, you've seen it in Heisenberg's uncertainty principle, where the act of observation changes the measurement itself. So this is profoundly different than than this self-referential nature, where you change the act of human beings being present changes the rules, is very different than laws in physics, for example. Human behavior isn't going to change Newton's laws of motion. But financial markets are different. The second reason financial markets are very different is they are, to use a technical term, non-ergodic, meaning that they are not subject to repeatable rules. And if you think about economic systems, political systems, they are driven by surprises and change, and they're path dependent, meaning how you got there influences where you're going to go. These are difficult concepts they're fundamentally different than places where machine learning has been very successful, like two-person games like chess or Go, or even image recognitions, where the rules are the same. A face is a face. And over time, the parameters that define a face are always going to be the same. That is not the case in financial markets, where there are, in fact, observable investment opportunities are driven by surprise. And it's very difficult for machine learning. In fact, one would argue that another element is something called this radical uncertainty concept, or what former Secretary of Defense Don Rumsfeld called unknown unknowns, which happens when all your data sets are based on white swans and then you see a black swan for the first time. Machine learning isn't very good at capturing that, and that's what financial crises are about, and that's where you lose a ton of money. The third place which is very different in terms of the application of machine learning is a practical one, which Laura alluded to, which is one of explainability and transparency. When something goes wrong, such as when you lose other people's money, it would be nice if you can explain what happened and why it happened. It matters to the person whose money you lost, and it matters to regulators who come and ask you. And many machine learning tools aren't explainable in that sense, which makes it challenging. So those are the three reasons I would describe why it's very difficult for machine. It's not impossible, it's just that we're in very early stages. So finally, in terms of the degree of adoption of machine learning in hedge funds, I would say, speaking broadly about the industry, that it's characterized more by hype than by the reality of what has been achieved. I think that there is a lot of promise there, but we're in the very early stages and infancy of applying these tools. And by the way, there's a spectrum of sophistication among market practitioners in terms of how they are using these tools. And there's natural secrecy and confidentiality associated with that. But generally speaking, where we are, I think, in machine learning is it is one tool in the arsenal of quants alongside other tools. And what is nice about machine learning is that many of these tools are open source. They've been battle tested. It's very easy to use them for quick tests in a way that is very different, for example, to some of the old statistical packages even. So that's what is most often being used today. But finally, what I would say is that we are, as human beings, we generally overestimate the impact that things can have over the next couple of years and underestimate the impact that things can have over 10 years. So I don't expect there will be anything transfer. I think we're far from the inflection curve, but 10 years from now, I would expect that there would be something much more material.
Thank you. Fascinating perspectives. And Kathleen, we'd love to hear from you as you work across industry and academia and startups and more established firms and see activity across a breadth of the finance sector. How do you see the trends moving?
Okay, so maybe I can actually find something or explain something that meets the scary black box. The decision was really made in a smoky black room, dark room, and we're just replicating it with machine learning and the time-tested expectations problem. So there's a really cool paper that was written last summer that I'm pretty sure that hedge funds are already adopting. Maybe you can let me know. But this is a paper that basically used both machine learning and a novel source of data, which was reading the text in annual reports. So forget all those numbers and balance sheets, cash flow statements, income statements, who cares? All it did was look at changes in language, specifically in the risk section of a 10K, and mined for negative changes in language. And then used machine learning to see if that was predictive of subsequent price changes. And lo and behold, yes it was, especially on the negative side. So folks, actually, instead of copy-pasting the annual report from one year to the next, you probably ought to pay attention to that 300-page risk section that nobody reads, because it actually does a pretty good job identifying trouble in advance, and particularly good on the short side. So I think that actually kind of passes the test that you guys identified. In terms of what I think is pretty interesting in startup land, things that are going on that probably the one I'd cite would be, because this question is all about kind of what to automate, right? And the things you want to automate are the things where if you're wrong, nobody dies. And then where does finance fall in sort of the predictability equation, right? Because you also like to automate things that are relatively predictable. So I think we'd all agree that finance is maybe 50-50, right? Lots of uncertainty in there, and especially the Knightian uncertainty, the unknown knowns, or the known unknowns or whatever. So I think what's interesting is that startups are now starting to combine lots of different types of data. So I was talking to an insurance FinTech entrepreneur yesterday, and he said, we're already looking at social data to make decisions about how to price insurance products. And I was like, ooh, what are you looking at? And I said, well, we look at your Facebook profile, and we'd like to know if you own a gun. And I was like, ooh, what else? What else are you looking at? I'm like, getting interested now, right? So, well, do you own a fast car? Are you hang gliding? Are you parachute jumping? Et cetera, et cetera. So one thing to kind of be cautious about or interested in is we're not making financial decisions about how you might price an insurance policy or make a loan based solely on your FICO score or these kind of old-fashioned traditional elements. We're now looking at things like social data, who you're hanging out with, and so forth. And this bumps up against some perimeters of whether these are things we really, really want to do in this society or in others.
Thank you. Very interesting perspectives, and as we think about those parts of alternative data in consumer finance that tickle our privacy sensitivities, we naturally think to the potential for regulation. And Ben and Laura, I'd like to ask each of you from your distinct perspectives, how do you see the impact of regulation on AI and alternative data in the businesses you're working in?
Yes, that's a very good question that is very relevant for IEX. So I'll just develop one example. As an exchange, we have to file with the SEC all the rules that we had and have to approve it. And one of the things that we had to fight for is we have an auto type that comes with a machine learning model. The machine learning model tries to predict interval price moves, and in order to protect the auto type and kind of move it away before the price move happens. We have to fight that. Because we have to fight that, there are a couple of questions. At a very trivial level, it has to be kind of Word document text. So we have to put all the equations in there. We did. You can check it out. How would we fight kind of a machine, a neural net, right? That's trivial. At a more interesting level, we are not confident that the SEC would be comfortable with kind of a black box, a neural net. We don't know that we would be very comfortable with a neural net. We feel that, so currently we use something relatively simple, which is a logistic regression, does a very good job. We may be able to get 10% performance improvement from sophisticated tools, but I'm not sure we would want to do that. We may feel, the SEC may feel that we're comfortable with a simple model we feel we can explain. Is that the right perspective on things? I'm not sure. How will things look like in 5 years, 10 years? Maybe it's an illusion to think that we understand better the simple model compared to the complicated model. So I have more questions than answers, but for sure this is a very, very practical question for us every day.
Yeah, and I would just add that, first and foremost, that hypothetical extra return you'd be generating is, of course, at what cost, right? Everything in finance is about balancing the potential reward or the expected reward versus the risk. So if you're getting an extra 10%, but it introduces a whole new suite of risks in your business, then likely it's not going to be something that your senior management and your board feel super comfortable about. This is a huge topic for our company in particular, because we're in the, if you will, explainable AI space, so it's definitely a hot button issue for us. There was a recent act that was proposed by 3 lawmakers down in Washington about a month ago. That's called the Algorithmic Accountability Act. Say that 5 times fast, quite a mouthful. But basically what the act does, and again, it's a bill right now, so it's not law. And if anybody has a way to actually give odds on whether or not a bill will be passed in Washington, I'd love to hear it, because again, that would be a very powerful algorithm. Though I know some of those actually do exist out there, but unlikely, in my personal humble opinion, that this will pass in its exact form as of now. But what that law really does is it provides the FTC, the Federal Trade Commission, with the authority to go into a company that has over $50 million of revenue and audit their algorithms that are used to make decisions about consumers. It's a pretty overarching regulation that is quite wide in its breadth, and I think would be quite challenging to potentially implement. But again, I'm not a Washington expert by any means. But what that regulation really does is it's a move towards the real, or an example of the real want and desire out there on the part of lawmakers and on the part of consumers to have a better understanding of what is going on, if you will, inside the black box or the gray box or whatever. Understand how the decisions that impact their life in a very small way, maybe like what ad you're served on Facebook, or in a much larger way, what job you get to interview with or what loan you get at what price. People want to understand how these algorithms work and how they're making decisions about them. Consumers want that. Regulators are listening, and I think it's only going to continue, and this act is a real sign of key movement in the U.S. towards that. We've seen that movement abroad with things like GDPR in Europe and open banking regulations abroad that are really focused on making sure that if you are using machine learning technologies, you have a human in the loop. All of the guidelines are from AI experts of how to best deploy these technologies in these types of situations, is to ensure you still have a human in the loop, you still have a human that is at very least sanity checking the way the model works. If the human can't understand how the model works and only see inputs go in and outputs go out, how can they make sure that it's not making biased predictions, or that it's making the predictions that can actually drive business forward? So I think this is a huge issue and will only continue to be more important going forward.
Thank you. So Kathleen and Hamid, I'd like to ask you how, again, since both of you bring a broad industry perspective and are both involved with markets as well as with different parts of investment management, how do you think AI is going to change the competitive landscape? And which sectors do you think are really prime for the most disruption?
Maybe one quick example of that, just take a simple one. How do we manage data in the enterprise? So I think one exciting potential change is that we used to think of it as more like a dictionary, right? You label things and look up things and things like that. And the future might be something more like Google Translate, which improved dramatically through the introduction of machine learning, where instead of having a dictionary with labels, we suddenly can essentially map data and find it all around the organization. So that strikes me as something that might become a competitive advantage. And with a technology-first company equipped to extract the most value from its data wherever it lives around the firm, that's potentially pretty darn interesting as an example.
So that's it's a great question. It's a vast question, and there are different aperture openings one can view this question through. Let me try to tackle it with a wide-angle lens and a macro lens. The wide-angle lens being that of incumbents versus startups, and then the macro lens zooming in on the hedge fund industry. So if you think about the strengths and weaknesses that incumbents bring versus startups, on the incumbent side, their strengths are sitting on vast oceans of data, huge customer base, deep financial resources. They're a regulated entity, and so they're used to dealing with the onerous requirements that regulators have on compliance and risk management issues. And people view them as trusted fiduciaries of their money. And the trust component is a very important one. Their disadvantage is that they sit on these massive legacy systems that don't talk well to each other, and they, as a result, this oceans of data that they're sitting on, they can't leverage. They are extremely bureaucratic, and so the kind of talent that wants to work in this space oftentimes isn't attracted to go there, and a lot of the brightest people are leaving these industries from the incumbent domain. And they just haven't been able to deliver the customer service and the customer experience that technology companies like Apple or Google and others have been able to provide. Startups have exactly the inverse of those strengths and weaknesses. And so this is not an easy space for for startups to attack and displace and disrupt incumbents, I don't think. And so I think what we're much more likely to see, and we're seeing that already, is a huge level of cooperation between incumbents and startups in a way that is very different from many other sectors. And that seems to be kind of the path that's going. So that's one element of the picture. I guess the other element is geography in this space of incumbents versus startups also matters. So if you're in China, where you don't have strong incumbents, where regulations are more permissive, where privacy laws are more permissive, where it's easier for technology companies to get into financial services, there's a very rapid growth of what used to be startups, and now they've become giants in FinTech, far better than many players that are in the West, with gigantic valuations. And they are likely to leverage that more lax privacy rules and so forth to continue to extract enormous intelligence using machine learning tools, for example, in terms of extracting information from vast quantities of data in a way that it's very difficult to do in developed markets. So that's kind of the way I see the incumbent versus startup picture. There's a geography element and there's a cooperation element in the developed markets.
One question. So Ant Financial is the largest fintech on the planet today. Clearly has the advantage of the monolithic tech company in China, the access to vast pools of data, et cetera. Ant Financial is expanding around the world, investing in Paytm in India, investing in payment systems around Asia. Will Ant Financial export its attitude towards privacy and data sharing when it crosses borders?
Well, that's a fascinating question, Kathleen. And the nub of it is they know that when they cross borders and they come to the US or Europe, they can't use individual customer information the way they've been able to do it in Japan. But the knowledge, the information, the rule invariance that they've been able to pick up from customer behavior, which is a lot of times rule invariant. Customers in terms of what their risk preferences are and what kind of investments they require doesn't change dramatically from one geography to the other. They can deploy that knowledge and come and compete in a way that is not a level playing field for...
Yeah. In other words, you don't actually have to redline, you can proxy for the redline.
Yeah. Correct. Yeah. Correct. So that, I think, from a competitive standpoint, is a massive issue for regulators to think about in terms of global, cross-border, level playing fields.
Yeah.
In terms of the hedge fund space, what I would say in terms of how the competitive dynamics might evolve is that you can think about it on a number of dimensions. First, on a talent dimension. My expectation is that these kinds of machine learning tools will not result in displacement of humans by machines. I would venture to guess that 5+ years from now, there will be just as many people employed in the hedge fund industry as they are today, even though there will be a lot more advances in machines. I think the world for the next 5 to 10 years is going to be one of augmentation of human intelligence as opposed to a displacement of human intelligence. So that's one dimension. In terms of skill set, you've got data scientists and engineers coming into finance, and you've got financial experts. These two groups together don't speak each other's language. The finance guys talk to data scientists, they don't know what to do with them or how to leverage them, and the data scientists don't know enough about financial model. Now, there are some firms that swear we don't want finance experts, we just want engineers and data scientists. And there are other firms that have the opposite point of view. What I think is going to happen over the next 5 years is these two skill sets will become more interlinked, and a new generation of experts will evolve. And I think programs like Princeton's Master in Finance, which really trains you across both fields, is an excellent example of how the next generation are going to evolve. And the last point is an organizational one, which is right now there's a distinction between, for example, discretionary PMs and quant PMs, portfolio managers. Discretionary PMs are those that do bottom-up fundamental analysis and develop conviction on a given stock. Quants use statistical techniques across broad categories or baskets of stocks. And these two groups are now organizationally separate. Machine learning will come to a point where it's deployed for both sets, and these distinctions become irrelevant over the next 5 years. And then the last thing is that there are scale advantages that come to this business because the investment in talent, the investment in these kinds of machine learning tools are expensive. I think those who are stuck in the middle can't amortize that across large assets under management are going to basically get left behind, and there'll be it'll become a more bipolar market where very large players with deep resources and some younger ones that deploy ingenuity and compete. So it'll be a very interesting time frame.
Excellent. Well, we want to leave time for audience questions. I'm sure that many have follow-ups, so Don.
So I'll walk the mic over to everyone who's got a question. Just raise your hand and give me a moment to get to you. Who's going to be first?
Hi, I'm Jody. I'm first year of a PhD student. My question is regarding the non-ergodic and self-referential properties. What are the procedures? What are the things people in practice will do to deal with these two special properties of financial?
That may be getting into a level of technicality that may not make sense for this audience. There are strategies to address these problems. They're very imperfect, and they're oftentimes secret in terms of their deployment. So it's not something that I can at least speak to publicly about. Sorry about that.
That means it was a great question.
It was a great question.
Other great questions.
I just have to add, in addition to the MFE really shaping the finance professionals of the future, of course, Orphe is doing that as well. Just had to thank you for the probing question from the Orphe PhD.
I'm Lou. I have a philosophical question. Everything I know about FinTech, I think I've learned in the last 30 minutes. I don't know very much about it, but I come from a publicly traded company for the last 30 years in the construction industry. And as part of that, we had a lot of interaction with investors, Wall Street analysts. And many of them were from the Wharton School and other prestigious places that did analysis, models. And in my dealings with them, I always came away saying, these folks really have no idea about our business and our company, and yet they're making some very critical influences on the value of our company. Everything I've heard tonight says we're going to further extremes, relying on, artificial intelligence and all. Do you folks have any reactions to that impression?
So this is not a FinTech meeting. This is actually I'm the cult leader of the FinTech megachurch. Well, welcome to my people. Look, I think what you're probably reacting to is, those earnings calls are tough, and the analysts can't possibly know as much about your business as you guys, and this is always a dynamic that actually contributes probably to some market efficiency, actually, that part of your job is getting the information out there and getting it tested and so forth. I don't really see that actually changing. If anything, there's more information and more noise, actually, that these analysts have to sift through, and that might make their job more difficult. But you want them there to help get your message out, to have a bull and a bear on the story, and to communicate with the investors as well. So I don't see that as a big problem in this new world. Do you guys?
Yeah, the only thing I would add to that is what is clearly changing, and some of it is getting commoditized, but some of it that is proprietary is not, is the use of alternative data, is the intelligent use of alternative data. And so some of the advantages that insiders and companies have by virtue of what they see inside is getting leveled out through ingenious techniques in terms of talking to suppliers of companies, in terms of imagery, in terms of a whole variety of techniques, understanding the customers to the point where some tools are able to predict the daily revenues of companies based on these alternative views of looking at it, as opposed to waiting once a quarter to hear what the company is saying about their numbers. And this will be an interesting forcing device, to Kathleen's point, in terms of bringing greater efficiency to markets. You can't hide behind numbers on a quarterly basis anymore. This is going to be a much more real-world experience.
Literally, people are flying drones over the Tesla distribution center.
And this represents, in certain ways, a natural that there used to be businesses that did retail channel checks, where investors, discretionary investors, would hire firms that would go out into retail stores and look at parking lots. And again, now that's being automated. And then there are businesses like ThinkNum, which Don mentioned earlier, and which I advise, which does similar things, but they're looking at the internet. Of course, why wouldn't you? They're not going behind paywalls, just what people are advertising. And you're doing effectively the same type of work, but you're making it much more accessible to a broader range of investors.
And if I can add one word. And if I can add one word, I think that IEX, to some large extent, would share some of your views, and we think that there is a large spectrum of market participants. There are long-term investors, and there are still many of them. There are also very short-term investors. Among those, some of them will maybe look only at X and Y, arbitrary, like abstract variables and very short horizons. Maybe they bring some value to the market in some sense, but we definitely think the first category of investors brings a lot of value to the market, and we want to think about a market that is designed with those investors in mind first and foremost.
Hi, I was just very interested in the parachuting sort of actuarial example. So I use some technology to cheat, and I actually looked it up, and I think the U.S. Parachuting Association estimates about a 0.61 fatality rate per 100,000 jumps, which is problematically safer than running triathlons. And this is not, it may have been a straw man example. I don't know why that decision was coming from an actuary. It may be valid, but just more generally, what is the risk in allowing people to guide the algorithms rather than allowing algorithms to maybe subvert expectations we might have that might be data-driven? And sort of, do you see a path to allowing sort of, us to be more data-driven? I guess another good example would be that we might not think about parachuting being safe the same way that we might have sort of hopeful, unrealistic expectations about how a hand of poker might turn out. and just kind of how do we move away from that? How do we open the way to actually using this technology for the purposes that it's sort of been conceived for?
Yeah, I'll say one thing, I'll hand it over to you, but I think one of the core properties of AI that hasn't really been mentioned yet is its emergent properties, right? So you can get unpredicted outcomes even from predictable rules. And that's kind of the big challenge of AI, and then maybe I'm going to hand it over to you to...
Yeah, I just wanted to say that I personally believe very strongly that the best outcomes are actually achieved when they work together, right? So when human and machine work in partnership, leveraging the best of each of them to arrive at better outcomes. So both humans and machines by themselves can be very biased and can be very exposed to prejudice and all of their sorts. I mean, I can run through a list of 10 different ways humans and or algorithms can be biased if used in a vacuum, one or the other. I think the important thing is that the best outcomes, especially I personally believe in finance, are achieved when these two things work in partnership. One, because neither has all the information, right? There's plenty of information that can be drawn from new, exciting data sources, like coming in and taking a drone of a parking lot, and many, many other ways that you can get really interesting and valuable data that has very, very meaningful value to add in whatever predictive challenge or risk challenge that you're looking at. On the flip side of that, if you just build a machine that only understands data, i.e. is only trained based on data, and then only understands the world in accordance with what you have fed it, then I also believe strongly that can lead to very, very bad outcomes. And if you're looking for someone to insure your para jumping or sailing or anything, there's a great company called Spot that offers 12 to 36-hour insurance. That's quite cool. For your next skydiving trip, Spot. Very cool company. And they apparently price it very affordably as well.
So my question is very much in concert with the last one you just asked. So if I had to, summarize that question, it would be, how do we keep people from affecting, the data decisions too much? How do we keep the data process rigorous? I guess my question is, to the extent that humans are still going to be involved, how do we try to balance out their biases? So, one of the more comic examples that this insurance executive gave was parachuting. One of probably the less comic ones was owning a gun. Certainly very dangerous, but also very charged politically. And you could think of things on the other side of the political spectrum that are probably pro-social, but maybe this person and people in tech more generally are not really thinking about. So how do you, is it just a hiring problem to get all these different perspectives on the table and start to think about these different biases if they're going to be introduced?
I mean, I'll start. I think it requires a rigorous process that a company needs to have in place to actually check these things. So it's not a one-off thing. It's not a, when I wake up in the morning, I feel like I want to check to see if my algorithms are biased today or my humans are biased. You have to deploy a company, if they want to use these technologies and have them actually drive their business forward and avoid the many potential risks that are associated with these technologies, they have to have a really rigorous plan for reviewing these technologies and how they're working and the types of decisions they're making. So there is a rigorous framework that companies can employ to check how their algorithms are working and, if you will, how their people are also working as well. That should be very structured, not one-off, not when people feel like it, just like a model review happens at financial institutions in a very rigorous way as well. So there should be deep structure around it and deep process around it to proactively check for these types of issues and then address them when you find them. That's also the only way I think you're going to be protected when the regulators come knocking. If we're again talking about bias can be defined in many, many different ways. I recently read a really good paper that basically said there are 4 main ways to define bias, and depending on which one you pick, you will always be biased. Like every single thing will always be biased, right? So, I think this goal of having unbiased algorithms is also a bit of a pipe dream and probably not achievable. I think the ones that are going to, again, be in good shape when the regulators come in knocking are the ones that have deployed rigorous frameworks to find these proactively and address them.
So I think one of the points that's coming out is what I tried to put in one of the questions, which is looking fulsomely at all the data available and being rigorous in your thinking about it. How could that be bad? And the answer is that really that looking at data and using it widely, and these technologies and modeling toolkits that allow us to incorporate data into more types of decision making should in some ways be unquestionably instruments of progress. On the other hand, data, there's no data set that captures everything in the world. And it's something Laura said very eloquently when she came to speak to our class. So your data is not your world. When Jeannie Tarkenton wants to lend to a student who no other lender will touch, a student who has never had a non-cosigned loan, she has to make an assumption. She has to infer from experience that doesn't exist yet. And so she has to be able to posit something about the world that isn't yet captured in data. And so I think it's thinking rigorously about data, but then also understanding very much what the limits can be. And so it's that notion that I think we're reacting to in machine learning sometimes, that all you need to do is get the data and the algorithm will take care of it. And I think what we're saying is you really need to respect your data and learn from it, but you also need to put a lot of thought into your process.
Hi, my name is Mark. So my question is, for highly regulated industries, whether it's insurance, as mentioned, or loans and so forth, it seems a little bit unrealistic to think that the providers would be, unbiased. There's always that incentive to take advantage of that information, even though the regulations might compel them not to use, let's say, social media data, things of that nature. Is there room on the other side? So there's the regulators come up, right, where typically they're, undersourced, and they don't really have a full understanding of the situation, and often they are, more partners with who they're regulating as opposed to truly kind of cops of them. Is there room on the other side in sort of a arms race or adversarial network, to use a network, neural network term, where the other side can determine that, hey, this company is being biased as some sort of social good. Are the folks doing that? Is that something of interest? I can imagine people submitting their loan applications to a third party that would aggregate that information and could determine that the providers were being biased, as an example.
So I can address that question, maybe take it a little bit away from bias and just give you a couple examples. So one is you can now have a compliance sheriff that's automated roaming around your company, kind of noting when somebody badges in and out at midnight, downloads their clients list, and then leaves in a limo. So this exists, called RegTech. And I can think of another example that might be useful to regulators, where if you have concentrated trading, like looking at exchanges or whatever, this gives a regulator potentially like a godlike view over what's happening, and that might be a useful view that could be informing many different decisions and conclusions about what's going on in the world. So that's, I think, an interesting opportunity as well.
We have time for one more question.
Hi, my name is Jim. I kind of have a bit of a counterpoint on AI. I'm an investor, and a lot of what I see as AI out there is frankly total bullshit. There's a bunch of people in some remote location who are just tagging data. So to the extent that you're willing to share about your own processes, for those of you who package and sell some version of AI to consumers, how much of it is real? How much of it are people behind the scenes? And then kind of just going to the overall question of what really is AI.
Laura, that's got to be your question, since
That's
you're
right.
the one.
That's right. I'll start on that one. I couldn't agree with you more. Everybody's seen the articles about how every single Fortune 500 mentioned AI in their annual and quarterly calls, and they have a very advanced AI strategy. Yet when you actually look underneath them, most of it's BS. A lot of it on the startup side is also the same. I was joking about chatbots. I literally have met a number of folks that have chatbot companies that literally just have humans responding in other countries. Not even exaggerating. 100% happening. Literally just have cheaper humans responding in other countries that speak English very well. So it's all over the place. And again, everybody wants to sprinkle a little AI on that, and everything can go. AI is a very, very broad church, and is something that defines a very wide range of technologies. Yet it is used as a term that is somehow singular, right? And often used and thrown around to mean a wide variety of things that it just doesn't mean. So I kind of completely agree with your approach. I think it's always important to when you hear someone mention the word AI, everybody that's here is obviously cares about this field. Like, your alarm bell should go off, if you will. It could be your BS indicator or whatever the heck you want to call it. Like, the bell should go off, and you should ask them what they mean by it. And you should ask them, when you say AI, what type of AI are you talking about? You should ask them to dive a little bit further. Oftentimes, again, AI is not AGI. It's not everything we've seen in the 80s movies that I love so much. It's, it, again, is a wide variety of things that is, again, not that. Our technology in particular uses machine learning, but in a proprietary way. So we have a proprietary family of algorithms that are at the heart of our solution that were developed by my, co-founding team over the last decade plus. So I like to think that we aren't BS, and we've got some really, really hardcore stuff under the hood. But a lot of times people deploy open source AI algorithms, and that is their AI that's part of their business. And guess what? That's fine. Ain't nothing wrong with open source AI algorithms. A lot of people really like them for a very good number of reasons. And what really matters is what is that AI, and we haven't necessarily gotten to this, but what is that AI doing for your business? Again, we talk everybody AI, sprinkle a little AI on this, but what business problem is that AI actually helping you solve? How is that AI helping you extract value from data or get you data that otherwise would have cost you a lot of man hours or is just not possible to have? How is it helping you find insights and data that otherwise you would have never found as a human, or that may be shocking to you or may not be what you think or where you're anchored to? So I think people should, one, focus on, is the AI technology really real, or are people using open source stuff that anybody could use? And then two, what the heck does that AI do for your business? And how is it helping moving your business forward, as opposed to just being smart people that do AI? Yeah.
Well, thank you. So I think that wraps it up for our official questions, and some great ones. I think that new sources of data and there have been really exciting advances in modeling. So it sounds like AI is everything, but it's also really something. And we all see its effects, and it's exciting to get to hear from Hamid and Laura and Ben and Kathleen about what's going on out there, and what they're making happen with these toolkits. And I thank all of you for joining us. I think we have refreshments and drinks afterwards, and we'll all look forward to joining you, and thank you so much for coming tonight.
Before we break, again, I also want to personally thank the panelists and Margaret, and on behalf of the Bendheim Center for Finance and the Princeton Entrepreneurship Council, a small gift as a token of our appreciation.
Thank you.
Thank you very much.
Thank you.
So let me just finish, because we have 140, 150 alumni in the room tonight, along with some aspiring alumni. So the question we're always asked, and one of the key initiatives of PEC, is to help you engage with the entrepreneurial ecosystem. Let me just leave you 3 quick thoughts about how you might do so. One is through mentoring. So we have several mentoring platforms and several sets of groups of mentees, if you will, who could benefit from experienced alumni. And of course, the alumni in this room can be either a mentor or a mentee. So if you have an interest in mentoring, please check out the entrepreneurs.princeton.edu website. It's a great platform that you can engage and be supportive in that regard. Number 2 is through funding. PEC actually manages one particular fund called Alumni Entrepreneurs Fund that Lauren Bender in the corner here manages. But we also support the entire venture community, and there's actually 3 venture firms that focus almost exclusively on Princeton startups. So if you are a founder and looking for money of a venture type, please see us and we can connect you. We also work really closely with Princeton Alumni Angels. Many representatives of that organization are here in the audience tonight, including Rob Walk and Charles and others. But Alumni Angels is a rapidly growing network of alumni, now sort of in the Bay Area and in New York in terms of chapters, but alumni really from across the world. So if you're interested to be an angel investor, get in touch with the folks at Princeton Alumni Angels. And then finally, this event is just one of many events that you can obviously engage as audience members or potentially as panelists. And on the screen behind me are some upcoming events that not only are TigerTalks events like this, but also a series of conferences, starting with reunions on Friday morning, continuing with actually a showcase that we're co-sponsoring with HBS and Princeton Alumni Angels in the summer, and then two more conferences actually in the fall. One that's part of the Black Alumni Conference, which is happening in early October, and then a day-long conference in New York City in early November, which will actually precede the big football game at Yankee Stadium, if you haven't heard about that yet, which will commemorate the 150th anniversary of collegiate football. So just one of several ways you can engage. If you have ideas for panel discussions, if you want to be a panelist, as I said, please see us, because we're trying to connect entrepreneurs, whether they're technology folks, or life sciences folks, or social impact folks, or artists, because they're all entrepreneurs, and Princeton is a really vibrant ecosystem, as evidenced by the great turnout tonight. So, with that, as Margaret said, please engage with each other for another hour or so. Thank you very much for coming out. Again, thank you to IEX.